Hi, this is Market Order. This is episode 3 in our recorded trading series. In this video, we're still trading on the US indices and also talk about one of the biggest challenges in the US financial markets. Trade number 4 is again on the Nasdaq. First, remember, what you're seeing here is the entry, the moment we open the trade. Every trader has a different strategy, a different analysis style, and different risk management. In our process, we study the main trend on higher time frames like the daily chart and above. Then on the 1-hour chart, we look for strong zones and good trading areas. Finally, we move to the execution part, the entry and trade management, which is what you see in these videos. This trade happened on the next trading day after the Federal Reserve meeting. The price had already erased the gains from the previous night and moved lower. In the early hours of the US market, we saw a pivot again on the 15-minute time frame, so we placed a long order. Since the price didn't drop further, it was a single entry. We opened the position with one lot, with a 150 pip stop loss, so the risk on this trade was about $1,500. After the US session ended and the Asian session started, the trade reached a 1-2 risk to reward. We closed 0.7 lot and took around $2,300 profit from the move. And if the price comes back to our entry point, we will exit the rest of the trade at break even, risk-free. Over the last year, the market grew more than 50%. A big reason was the optimistic mood after Trump returned to the spotlight and the expectation of easier financial conditions and pressure for lower rates. You could also see this change in the bond market, especially in the spread between the 10-year and the 2-year US Treasury yields. When this spread turns positive, it often shows stronger confidence and more demand in the market. But the main worry these days is liquidity. There is not enough cash in the market. Some fund managers shared a chart that really stands out. Cash levels inside funds have dropped to a risky zone. When cash falls to around 3.7% or lower, it has been very rare since 2002. And in those past cases, the stock market had a big pullback within 1 to 3 months, while US Treasury bonds performed better. This warning doesn't mean a crash must happen now. It's possible we see a deeper correction at some point in 2026. But we should remember, at the start of 2025, big banks like Goldman Sachs also expected a drop, and the market moved in the opposite direction. Still, with inflation expectations and rising global tensions, we can't ignore the risk of a correction this year. At the end of December, we also saw Google release a new version of its AI. So the conclusion so far is, competition and productivity in the tech market are still strong. In other words, the market still hasn't found a clear reason for a deep crash of 30% to 50%. Right now, the bond market is still in a reasonable area, but if yields move toward 5%, that can become a serious warning level and a sign that bigger pressure may hit the market.